Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special investing report brought to you in association with ASB. Today I want to talk about the great corporate bond rush of 2009. You might remember back in October the government announced government guarantees for banks and for finance companies because of the turmoil on global markets. Now this meant that many banks and finance companies saw an initial rush of money as people put their money in these government guaranteed term deposits and debentures. But that has slowed to a trickle, particularly for finance companies, because they've all cut their interest rates. We've also seen the official cash rate cut from 8.25% late last year to 3.5% now, and probably falling to 2% within the next 6 months. So many investors are looking around for places where they can get a higher yield. And many corporates as well are looking around for other ways to raise money. For a while they used to do it in the wholesale markets. They'd go overseas and raise some money. Or they'd get it from banks here in New Zealand. But the banks here in New Zealand are charging quite a high rate, and it's almost impossible to get the money on wholesale markets. So they're seeing an opportunity. Perhaps they could raise it from mums and dads who are looking for a higher return. So that's what we've seen. Through December and into January, there is $1.1 billion worth of corporate bonds either completed or in the pipeline. And this week we've seen Fonterraâs announce plans to raise $300 million, offering an interest rate of 7.75% on some longer term bonds. Tower is also planning to raise up to $100 million with a 5-year bond. New Zealand Post, government owns New Zealand Post, plans to raise up to $200 million through a bond issue in March or April. Genesisâ NZ, just before Christmas, raised $225 million. Akl Airport is currently raising another $50 million. Remember, they got $130 million in November. Wlgtn Airport too is in the process of raising $50 million at 7.5%. So it's worth asking the question, if I'm going to go into a corporate bond, what sort of things should I think about or look for? Because these corporate bonds are not government guaranteed. And they're not like a normal bank account. They're not. The banks are obviously regulated by the Reserve Bank. These companies are not regulated by the Reserve Bank. So you have to ask some interesting questions. Firstly, is it government guaranteed or owned? And obviously companies like New Zealand Post and Genesisâ NZ are government owned. So you could argue they're backed by the government and therefore carry a similar sort of level of safety as the government. Although you'd have to be a bit careful. Also, does it have a monopoly? Obviously, companies with monopolies tend to repay their debts much more easily. And you have to think about some of these power companies as virtual monopolies, and the airports as well. Wellington and Auckland are the only commercial airports in their cities. What is its credit rating? Have a look at what Standard & Poor's and Fitch are saying. And remember, the banks now are on AA. And most corporate bonds have less security than that. They're less than AA. And then you've got to ask, what else is around and what are people offering? Well, banks and finance companies, particularly banks at the moment, are offering about 3.5%. Finance companies giving you 5.5% to 6%, depending on who you go with. Those are all government guaranteed, but the guarantee comes off in October 2010. Also, many of these bonds on offer are for 5 and 6 year periods. And you've got to ask yourself the question, what is the global economy and the New Zealand economy and this company going to look like in 5 or 6 years' time? Will it still be around? Will its products still be popular? What will happen to the New Zealand economy? All questions to ask when you're thinking about investing in a corporate bond. I'm Bernard Hickey. That was a special investing report brought to you in association with ASB.